Despite growing threats to isolate Russia from the system known as SWIFT, many Western countries have included the decision in the last step by punishing Moscow, in view of potential damage to Russian banks, with serious and severe repercussions on the economies imported from Russia, especially gas and oil, as well as this cause major disruption of international trading system and make it difficult for European creditors to recover their money in return for Russian efforts that have paved the way nearly 10 years ago to build an alternative payment system. Data from the Bank for International Settlements show that European lenders hold a big share of foreign banks' exposure to Russia, as the system has more than 11,000 financial institutions in 200 countries, and Italian and French banks have debts of $25 billion on Russia, and the Austrians with more than $17.5 billion, while the American banks aspire to recover the royalties of Russia on $15 billion. Arabs await decisions, fearing the repercussions of isolation on their economies, as Russia has in recent years stepped up its commercial and investment presence in many Arab countries and embarked on what the West calls economic nuclear weapons, would disrupt the activity of most foreign operations associated with Russian entities. The expected Western approach risks paralyzing trade between Russia and the Arab countries, estimated at more than $18 billion a year, and freezing more than $50 billion of direct Russian investment in the region in return of Arab investments exceeding $6 billion in Russia.